Hello there again. We continue the Elliott Waves adapted to, or the Elliott Waves theory for the binary options industry. And on the first part we discussed the basic concept of the Elliott Waves theory, namely 5 ways up corrected with 3 ways down, or a bullish impulsive move corrected by a bearish impulsive move, or if you have a bearish trend, then you have a 5 ways down corrected with 3 ways up. I would like here to introduce the rules for an impulsive move, how to treat an impulsive move, and if I represented the Elliott wave cycle in a bullish scenario on the first part of this dedicated to Elliott waves, this time let's build an Elliott wave cycle on the first part of it with an impulsive wave, a bearish impulsive wave. 1, 2, 3, 4, 5. Now you already have a bias, because this is an impulsive move. Let's put it in here. So this is an impulsive wave, and according to Elliott, an impulsive wave is always a 5-wave structure. Not only that it's a 5-wave structure, it is a 5-wave structure labeled with numbers. Therefore, let me change the character here. Therefore, whenever you look at an Elliott Waves analysis and you see a number on a count, that means it's an impulsive wave. So this is wave 1, we said. Let's make it bigger this time. So 1, the first wave. The second wave. The third wave. The fourth wave, and the fifth wave. 1, 2, 3, 4, 5. This is what makes an impulsive move, an impulsive wave, the first part of an Elliott wave cycle. But as mentioned on the first part, the key here, the key to understanding Elliott waves is to put the count in a cycle of a bigger degree. What does it mean? It means that the first move here to the downside may simply be, or not, it may be. It has 1, 2, 3, 4, 5. 5 waves of a lower degree, corrected by A, B, C, and so on. And this 1, 2, 3, 4, 5 will very well may be a first wave of an impulsive wave of a bigger degree. So let's make it a bit bigger and of a different color, like this. Let's make it even bigger. Edit, let's make it on 24, like this. So this would be the first wave of a bigger degree. Namely, what would be the next move after such an impulsive move? The next move would be a correction, a corrective wave, something like this, a correction, and that would be only the second wave, of the same degree like the degree that ended here. Now what makes an impulsive wave? An impulsive wave, first of all, we said that it's a 5-wave structure. 1, 2, 3, 4, 5. Let's look at some rules of an impulsive wave. First of all, in an impulsive wave, let's clone this one and put it in here. Let's make it a bit bigger. In an impulsive wave, wave 1, wave 3, and wave 5, the fifth wave, they are all impulsive waves on their own. Namely, if you look at the move to respect the rules of an impulsive wave for this structure, the same rules should be valid for this first wave, for the third wave, and for the fifth wave. In an impulsive wave, the second and the fourth wave are corrective waves. Obviously, you have only 2 options when it comes to Elliott waves. Either a move is impulsive or corrective. If the first, the third, and the fifth are impulsive, then the second and the fourth are corrective. One important Elliott wave rule states that the second wave in an impulsive wave cannot completely retrace the start of the move. Namely, in this case, we have what? We have 1, 2, 3, 4, 5, correct? And then this makes the first wave, and this makes the second wave. If we want to trade, or if we find a 5-way structure to the downside, or a bearish 5-way structure, and we want to trade put options on a retracement for that, what would be the invalidation? Where we would say, well, we are wrong, I don't want to trade anymore because the market or the analysis was wrong. But price, let's take a shape. Simply, if this 5-way structure is correct, price cannot completely retrace the impulsive wave. So the second wave cannot retrace, cannot go beyond the start of the first wave. So if we are to buy some put options here, we will buy some put options on what? On 50% retracement. We will buy some put options on 61.8 retracement, and so on. Of course, adjusting the expiration date with the time frame that we make the analysis. Now this is the daily chart on the Australian dollar, US dollar, but I use this daily chart only to have a bit of room here to explain the concepts of Elliott waves. Another rule of an impulsive wave states that at least one wave needs to be extended. What does it mean extended? Oh, by the way, the same principle that we use for this second wave of a bigger degree, we can use for this second wave of a lower degree. After an impulsive wave, wave 1 out of this degree, no part of the second wave can go beyond the start of it. So this is a very nice place to go and buy a put option if we do have a 5-way structure to the downside. We buy a put option here with an expiration date according to the time frame. What next? Well, at least one wave needs to be extended. What does it mean? It means that it must be bigger than 161.8 of the first wave, at least when compared with the longest. So we go and take a Fibonacci, we find a Fibonacci expansion or a retracement, it doesn't matter. We measure the length of the first wave, and then we look at 161.8. From here to here we have 161.8, right? Then we take the outcome and we project it from the end of the second wave. We must know here where the end of the second wave ends exactly. As you can see, the third wave that follows, or the move that follows, or the impulsive wave that follows, is bigger than 161.8 when compared with the length of the first wave. That's an extension. It means that the overall first wave in blue here has an extension. Any impulsive wave must have an extension. Extension is mandatory, and the 161.8 extension is only the minimum distance for the price to travel. It may travel 261.8, 461, or staggering amounts in very strong trends. Now you know the basics of an impulsive wave. With the next recording we will move to the basics of a corrective wave, and then with further details. Stay tuned.